Andrea Kramer, Market Analyst with Schaeffer's Investment Research. Today we're continuing our video series based on the Schaeffer's Home Study Program, 10 Days to Successful Options Trading. In today's lesson, we're going to examine the basics of covered call writing. The covered call strategy is implemented when an investor writes a call against a stock in his or her portfolio. More specifically, the trader would sell one call, usually out of the money, for every 100 shares he or she owns. The covered call writer is typically looking to achieve one of two objectives: add income on a stagnating stock or lower his or her break-even point on a stock purchase. For example, let's say you own 100 shares of stock XYZ. You're long-term bullish on the stock, but think it may remain range-bound in the near term. The premium received from selling a call on XYZ can increase the rate of return by providing income on the position when the shares are sluggish. On the other hand, a sold call can reduce the stock's downside risk, as the premium collected provides a cushion if XYZ unexpectedly dips lower in the near term. However, the buffer provided by the covered call is generally modest and won't provide against significant declines. The primary disadvantage to covered call writing is that the investor limits the upside potential of his or her stock position. No matter how high the shares rise, the stock has an established maximum selling price. For example, if you sold an XYZ 80 strike call and the shares of XYZ rally to the 100 level by expiration, you'd have to unload your stock at a discount to the current market price, considering your obligation to deliver the shares at the strike price when called away by the buyer. Had you simply held on to the 100 shares of XYZ without selling the covered call, your stock position would have netted a 20-point gain. With that in mind, investors that remain strongly bullish on an underlying security should probably avoid writing a covered call against the stock in order to fully participate in the equity's upside potential. On the flip side, if the investor becomes strongly bearish on the underlying stock, he or she should consider simply selling the existing position or consider buying a protective put. That's all we're going to do for now, but be sure to tune in next week when we'll delve into the exciting world of credit spreads. Once again, I'm Andrea Kramer, and thank you very much for watching. For more information on option trading or to keep up with general activity on Wall Street, keep your browser here at schaeffersresearch.com.